This is Fintech Insider News. This week, we discuss Xflow, the fintech looking to revolutionize cross-border payments in India. Chase doubles down on the physical bank branch, and Stacks has raised $23 million with their CEO joining us to tell us all about it. We'll be tackling all of this and much, much more on today's news show, so do not go anywhere.
Disney Plus wants to know, are you ready? For Marvel Studios' Thunderbolts, The New Avengers, now streaming on Disney Plus.
Let's do this.
One of the best Marvel movies of all time is now streaming on Disney Plus.
Hey, you weren't listening to me.
I said Thunderbolts, The New Avengers is now streaming on Disney Plus.
Meet the New Avengers.
That's a cool name.
Marvel Studios' Thunderbolts, The New Avengers, rated PG-13, now streaming on, you guessed it, Disney Plus.
Hello and welcome to episode, goodness me, 1042 of Fintech Insider News. I remember when it was 2. How good is that? Brought to you by 11FS, the 5-time Consultancy of the Year winners that work with financial providers, big and small, to build next-generation financial services. My name is David Brear. I'm the CEO here at 11FS. To help me unpack the biggest and the most interesting stories from the fintech and financial services news of the week, I'm joined by an absolute brilliant panel of guests. First up, we have 11FS colleague Joe Colchester, Head of Product at 11FS Pulse. How's it going, Joe? I mean, I know how it's going. You were up late last night at an 11FS event, weren't you?
I was, yes. It was the Pulse Special Open Mic Night, which is always an 11FS favorite, where we kind of talk to the community and really pass the mic around. And some very interesting people there, very diverse group of people, and all sorts of topics covered. So it was a late and interesting night for sure.
Good conversation. The pizza was good too. Like, I was very impressed.
Also good, yeah.
But no, it was a good one. I have to say, for excuses of late nights in London, then that's a definitely good one. So yeah, everybody listening to this who is in London, keep your ears out for the next one, because it's always a good event. Next up, we have a Fintech Insider debut for Albert Malikov, who is the founder and CEO of Stacks. Welcome to the show, Albert. How are you doing?
Doing well. Thank you so much for having me. Very excited.
I mean, you've got some big news. I don't want to jump into it too soon. We'll come to it when we get to it. But clearly quite a busy week, eh?
It was.
For anybody who doesn't know, tell us more. I mean, your role, and I mean, founding something is like having a baby, isn't it? But being the founder, being the CEO, tell us a little bit more about Stacks, and we'll come to the breaking news later on in the show.
Yeah, absolutely. So it was definitely quite interesting 2 years since founding Stacks. Stacks is AI platform helping mid to large enterprises, their in-house accounting teams, to really streamline monthly financial close workflows such as journal entries, reconciliations, and then reporting. So we're helping our customers to close faster with a lot more accuracy and controls in place. Before starting Stacks, I've been in fintech for some time, been building different products in the space for more than 10 years. Started off at Uber. Uber's fintech team was one of the first product managers there. That was in the Bay Area, and then moved over to Amsterdam with Uber, helping to build the fintech team here on the European soil. After Uber, I joined to build the European business of Plaid. Did that for some time, so it was incredible experiences. Yeah, looking forward for the conversation today.
I mean, if you keep those that dots of that trajectory of Uber to Plaid to Stacks going, then you're onto some good stuff, right? So, but yeah, we'll talk about that more as we go on. But welcome to the show, and great to have you on. Last but no means least, completing our lineup, we have a return to the show for Aditi Subbarao, who is the enterprise sales financial services for Snowflake. How are you doing?
I'm very good, David. Thank you so much. It's always great to be here. Unfortunately, I couldn't make it yesterday evening, but I was just taking a second to breathe through my PTSD when you mentioned like starting up is like having a baby. I've had 2 babies, and maybe that's why I'm never going to start up anything myself.
Yeah, you know what you're getting yourself into at that stage, don't you?
Exactly. But on the flip side, it has been an exciting few weeks at Snowflake since I joined late last year. We've put out a whole bunch of new functionality and features on the platform, especially in the agentic AI space for data activation, including something we call COCO or Cortex Code. We've onboarded a whole new set of customers, and I'm definitely seeing a pronounced shift in the feeling, almost the vibe in the space, from going from a lot of storytelling and talking and experimentation to actually understanding that data and AI are linked very closely together and turning all of that talk into substance. So it's going to be an exciting year, definitely.
Yeah, there's a place for talking and there's a place for doing, isn't there, for sure? But
Exactly.
for anybody who listening to this, I know Snowflake, you guys have been on a number of times in the past, but for anybody who doesn't know Snowflake, give us the pitch.
Absolutely. So Snowflake is the AI data cloud platform for the new era. And what that means is it is a single unified place for having all of the capabilities that you need for data storage, data processing, and actually leveraging that data in an AI-ready format to be able to serve your customers and your business in the best possible way through agentic AI frameworks and capabilities. We also have a very strong data ecosystem of thousands of customers who are sharing their data on the platform in a zero copy format. So effectively, for any organization that is looking to make the most of their data, Snowflake would be the place to go.
Very good. You practiced that. That is impressive.
Oh my goodness, I've just been through my onboarding program, so I hope when my boss listens to me, he'll be okay with this.
I think you nailed that. Yeah, you definitely nailed it. Well, that's awesome. Well, thank you very much for coming on the show as well. And what we'll do, we'll get on with it because there's a hell of a lot of stuff that's been happening in the news, and we really are probably going to be running up against time to get through it all. So, all right, our first story this week, and it just so happens we have somebody to talk about with this one, which is really, really handy. So, Stacks raises $23 million to Reinvent finance operations with Agentic AI. So this we picked up in FF News, was covered in a whole bunch of places this week as well. But Stacks raises $23 million, Series A rounds less than a year after its $12 million seed round, positioning itself as infrastructure for Agentic finance. It's aiming to shift CFO teams from execution-heavy tasks to real-time visibility and strategic analysis by building an AI-ready financial data layer and deploying automated agents across workflows. Since emerging from stealth, Stacks has onboarded 30-plus enterprise customers and reportedly saved finance teams over 100,000 hours annually by automating tasks like reconciliation, journal entries, and the month end. I mean, Albert, we really should come to you. I mean, this is amazing. I mean, it sounds like you're sort of putting a CFO in people's pockets, aren't you? Getting out of the way all of the manual, boring stuff and allowing them to do much more value-added pieces. But I guess first things first, congratulations on the raise. Tell us a little bit more about Stacks in a bit more detail. And always the question is like, what are you doing with the money then, I guess?
Thank you so much, David. Thanks for this great introduction. And I really like how you put it, putting a CFO in the pocket. So I have my own version of that, but I never heard this one, so I'll probably reuse it.
Feel free. It's you can use it. It's not my trademark, honestly.
So basically, when we think about the core finance workflows and basically the job number one for any CFO, that's closing the books. So this is incredibly painful and manual workflow. More than 60% of the finance teams usually in some way touching monthly financial close. It's stressful for the teams. And the result of all of this is that I think it was put nicely by one of the controllers that I spoke before starting the company when we were interviewing a lot of potential customers. He told us that his team spending 80% of the time on all these manual data manipulations and just 20% of the time on driving insights from the data. And for us, that was a moment when we were thinking that, there's like a tremendous potential in these teams if you flip that equation and just like give them the tools to really focus on what is important. So what we are building and sort of the products that we have is really just like focused on those core data workflows in largely, so this problem is a data problem. So you have multiple different systems. You're bringing the data, putting business logic on top of that data, and then entering this data into the core systems of the records, such as ERPs. And then you're doing a lot of reconciliation use cases on top of that. And then after that, just reporting out this data in the different formats and driving insights out of that. So that's basically the core of this. But then, as you mentioned, David, so when we look at this problem, we just realize that the data is the core of all of this. And just to get good results, to build intelligent system on top of that, we need to have like a very solid foundation there. So we build that AI parallel ledger connecting to the ERPs and really sort of like just bringing the data, not just from ERP, but from other systems as well inside the company, and preparing it for building those workflows. And then on top of that layer, what we have is deterministic machine learning tools such as transaction matching, categorization, and many others to prepare and manipulate this data. So finance is an interesting space. First, like accuracy matters. Second, there's a lot of math involved. So you cannot just simply throw this data into the LLM and hope for the best. So that foundational layer was very important for us to achieve the accuracy levels that teams require. And then on top of that, why we say that we're agentic platform is we built workflows with agent orchestrating those workflows. Interestingly, every enterprise has slightly different variation of the workflows. If you build that in previous paradigm of software with if-else automation and with deterministic linear workflows, it's just like you need to build customization for every customer, which is not scalable. So we have this amazing technology today that allowing agents to control the workflow and reason based on the inputs that we're seeing. So that's the workflow layer that we build on top of that, and that's the platform that we have today and continue developing.
Just to interject there, listening to this podcast, we've got CEOs of banks all the way through a student just kind of getting into fintech. When you talk about agentic finance and agents there, just sort of break that down a little bit in terms of how you're pushing those to manage the workflow.
Absolutely, yeah. So think about the simplest workflow that is very important for every team, which is bank account reconciliation. So you have transactions coming from your bank account, then you have transactions in your ERP system, and you need to match those together. And so your balances have to be verified and just like fully reconciled. So what the agents is doing is just like listening for all new transactions coming on each side. When new transaction is coming, the agent is calling for the tools, such as matching tools, and try to find the corresponding transactions on the other side of the equation. And if it works, then it's perfect. So it's like everything is saved for the future audits. If not, so there's some exception handling is happening where sort of like what actually next step is required to solve that. And those agents, they are learning from the actions of the accountants on the platform. So the action could be just like do nothing because the other side of the transaction will come in 2 days because that's the pattern that is happening month over the month. Or the action could be just like, oh, we need to make a journal entry. We need to categorize this transaction and put it in your ERP system. And so agent starts that workflow. So that type of reasoning and then exception handling is where so the systems called agents are pretty good at.
Very cool. And it's amazing setup that, because we've always said this, building out business banking capability. I mean, nobody starts a business to do their finances, do they? So what type of customer are you aiming at for this? Is it the sort of smaller end of things, or is it people with a growing finance team or a bigger established team? How sophisticated is the agents and the models that you're using?
So our mission is really giving as much time as possible to the teams working on this problem. And then when you think about all potential possibility of just giving that time back, it is very much concentrated with the larger companies, with the larger enterprises that have hundreds of people in their teams working on these workflows. So naturally, we tend to just go into those use cases and those companies. But then we also see that. So we have customers starting from 300 people and have customers with the companies that 10,000 people and more, public companies. So it's pretty wide range, but usually those companies are the companies that have their accounting in-house. So they have at least 10 plus team members in their teams that are working on this workflows. They also already made a migration to more sophisticated ERP systems such as Oracle, NetSuite, Microsoft Dynamics, SAP, Workday, etc. So those are like more complex use cases compared to maybe like less complex use cases where just the companies are smaller and using Xero, where the challenges are a little bit different compared to what we're solving.
Yeah, it's an amazing problem you're unplugging for people, because the sort of automation of those processes again can spiral into needing teams and teams of people just to create the data, let alone actually doing any analysis or any insights on it. And that's the point in having data in its first place, isn't it? To do something with it, to steer the business in a better place, or make decisions that otherwise you wouldn't be able to make. So I mean, this becomes I always think, the best uses of technology are the ones that democratize the things that the next 10 tiers up from you would be able to do, but you don't have the capacity to do that. You're creating if you've got a team of 10, it multiplies the effect 10x to have a team of 100, doesn't it? Which is really, really impressive. I guess this is also sort of coinciding with the launch of, you've got a product called AI Flux Analysis. How does that tie in with this, or is that's another solution in the suite of things that you're bringing to the market?
Flux explanations are usually the workflows that are happening at the end of the monthly financial close. Like once you entered all the major transactions into your ledger, you reconcile them, you would like to understand what are the drivers for the key differences in certain accounts. Let's say you have a marketing spend is going up 30% this month. So all the key stakeholders would like to understand what's driving that. And for large enterprises, there are hundreds of accounts like this where you need to understand what are the key drivers for the changes. And usually the way it works, teams they downloading a lot of transactions, they building crazy pivot tables to understand what's really driving the change, what are the transactions driving the change for each of the accounts, and then they find the differences. They try to look at the other month as well. And then they're writing down the explanation in the Excel spreadsheets for that. So as you can imagine, so this process takes hours and days. So our Flux analysis connects to the data. So again, we're using our data layer. We're using deterministic tools to do the math, to understand seasonality, to understand which transactions are new, which are not new. We categorize transactions as well based on the metadata that is available. It's like departments, categories, cost centers inside the ERP. So we're actually getting a lot of this context around the transactions. And the magic there is for this hundreds of accounts, with one click, within 20 seconds, you're getting the explanations. And the way we are measuring efficiency of our product is, so we're showing these explanations in the app to the users, they're reading, and if they are explanations acceptable, they can do. So we also, interestingly, like providing the transactions overview, like which transactions are driving that. So like you don't need to spend time looking for those transactions, so you can easily double check the explanation. So if there are some edits by the users, then sort of like we consider that, okay, like we need to continue working, we're learning from the edits. But what we're seeing is that more than 95% of the explanations are not being edited. So they are accurate enough as a first go already. So as you can imagine, this product saves a lot of time to the teams, but also gives visibility to broader finance teams and broader leadership on what actually sort of like going on in the business.
No, it's super cool. Bringing in the other guys, I mean, Aditi, I mean, this is the type of AI can add so many value in so many different places, but, predictable processes that actually take up a lot of manual effort for people, kind of automating all of those things and injecting some intelligence in there as well. I mean, this is a great use case for that. I know there's so many more problems that can be fixed, but actually this is a really important one for any business out there, isn't it?
Absolutely. And in fact, David, that is the reason why I love so many things about the Stack story and what you've just been describing, Albert, because almost 2-3 years ago, when we went from the kind of traditional AI world into the generative AI world, there were certainly some pockets or some business lines that were fast movers, early adopters, and traditional data-intensive workflows like KYC, like onboarding, like AML, like reconciliation, etc., were the first ones to pick that up. But from a generative AI perspective, most use cases tended to be in the summarization, reporting, marketing spaces. And there are two aspects of what you've described that I think are really interesting. The first one is finance is typically a very slow mover in terms of any kind of automation, any kind of innovation and technology adoption for understandable reasons, right? They are not incentivized to do new things. They have much more downside to taking risks than they have upside, and they are typically a cost center. To add to that, when you think of that in the domain of generative AI and agentic AI, if you are, say, putting together copy for a new marketing campaign, there is no such thing as accuracy, right? You can have, say, 70-80% accuracy. You can have the right disclaimers. You can perhaps get your ICP a little wrong. It's all okay. In finance, you get one number wrong, and you've effectively crashed your share price for who knows how long. So these two reasons always made finance a bit of a laggard. But what you are describing, and I think that is the interesting piece here, for use cases such as this, which will benefit from automation, which will benefit from reducing manual work, the key to the unlock is that clever combination of three really important things. One is the data, which is reliable, which is ready, and which is comprehensive, which comes through your data layer, Albert. The second piece is the deterministic models. Because a lot of the analytics that you do, especially in the finance space, they're not ad hoc. They're not new. You know what calculations you need to do and you know what you need to get to. And deterministic ML models will have a much better chance of the correct outcomes than sort of generative models. But the fact that you are now layering the agentic piece for the workflow, I think that is a very intelligent recipe. And I almost see that as a blueprint for now starting to unlock use cases like finance, like legal, for example, maybe recruitment, maybe hiring, maybe performance reviews, where you do need to have a combination of deterministic and agentic/generative to be able to get genuine business value. So yeah, congratulations again. I think that's a fantastic positioning.
If you're going to start, pick a difficult place to start and see what happens. But I mean, as you say, and Colts, look, I don't want to keep going back to open mic night last night, but actually, this is something that came up a little bit there.
It was the biggest topic. Yeah.
Well, and the next bit that you talk about is regulation in all of the spaces, isn't it? Finance, highly regulated, structured ways, submissions are all got to be, but whether it's wealth or whether it's retail or whatever, the regulatory part of it plays a big part, doesn't it?
Absolutely. And we need trailblazers like you to kind of set the tone and make the right risks and assume that risk because then it kind of builds up trust, because trust, and especially agentic AI, isn't there at the moment. But people need to make this first move. And it sounds like kind of back office approach, which you're going for, is actually the right way to go, because I think users on a kind of B2C level aren't really ready for it. But this kind of more back office approach, I think there's way more opportunities there to actually develop products from the ground up. What came up a lot, though, was the need for human intervention, human oversight, and kind of guardrails. And I'm just wondering what the kind of control framework there is for you guys over there.
This is such a spot-on question. So the way we build the system is, so we have tools for teams, for the accountants, to complete the work using the tools. I call it in a semi-automated way. So every workflow can be completed by just clicking the buttons and checking the final work. Obviously, every transaction, everything is saved for audits in the future, so all controls are there. And then you have layers of approvals, just people coming in and just like all compliance and auditability of that system. But also in parallel to that, so we have the agents that are looking at what's happening there and learning from the actions of the humans there and just becoming smarter over the time. So you have the system that is have the all the controls in place. So you have all the tools to just click the buttons and complete the workflow. And you have a smart system that sort of like learning and completing more and more automation there. So I call it like a human in the loop system. And to me, it's a little bit similar to autopilot on the airplane. So like we just have like airplanes flying using the autopilot, but at any point of time, pilots can actually take over control and just land the airplane, and you have like all the controls built in there. So this is similar concept how we actually thinking about the space and how we're building the frameworks for the control and auditability.
Yeah, that's a really nice way of putting it.
Yeah, it's an interesting one, isn't it? I'd liken it to the stage we're at now. The pilot can't take their hands off the steering wheel, can they? It's more like a Tesla's autopilot. You've got to be present, else it beeps at you a lot. But it won't be long before it's doing it all himself. Look, we're going to have to move on. I'm afraid we could probably talk about this one for the entirety of the show. But Albert, congratulations. Like I say, on the basis of your two previous companies, I reckon this one's going to go all right, which is good. So, we'll continue with the show, and no doubt we'll bring you back to talk more about this one as things transpire as well. All right, next story that we had: Stripe PayPal Ventures bet on India's Xflow to fix cross-border B2B payments. TechCrunch picked this one up and a bunch of other places. Xflow raised $16.6 million in a Series A round led by General Catalyst, with participation from existing investors including Stripe, Lightspeed, and a new backing from PayPal Ventures. The round values the company at around $85 million post-money. Xflow builds infrastructure to simplify and speed up cross-border B2B payments for Indian businesses, a segment often slowed by bank wires, opaque fees, and long settlement times. Going to Joe, Aditi, do you want to jump in on this one? I mean, good investment in a company that's doing well in a market that needs this type of thing. It's like as far as triangulation goes of opportunity against the action, then Aditi, maybe coming to you. I mean, feels like a good opportunity for them to keep growing in this space, and the backing by such big people. These guys, Stripe, don't often get anything wrong, do they?
David, when I read the story, I had two conflicting feelings. The first one was, oh my goodness, I am so glad I went through all the pain of remitting money from foreign countries into India. Ironic. And then the second piece is, okay, this is really interesting because finally that pain might not be as bad the next time. So I definitely think this is very interesting from three perspectives. So the first one is the actual pain. Like I said, in India, it is so funny, and I've spoken about this before on this show also. Domestic payments operate as though they are, 10 years forward. You can literally buy one banana from a roadside vendor by scanning a QR code or with one click on your phone. The Indian UPI system, as they call it, or the Unified Payments Interface, it is extremely efficient, extremely futuristic, very low friction, very low fees, right? So domestic payments are fabulous. But the moment you start crossing borders, and obviously this is like India is a restricted capital account market. The currency is not freely convertible. There's immense regulation in actually moving capital and money to and fro across the borders. But the moment you start getting into cross-border payments, it is a whole minefield, and it's really, really painful. So I think from the pain perspective, Xflow have definitely hit the nail on the head. The other piece of this, which is interesting, is the way they've structured the offering. So if you look at some of the quotes which their founder has made in the article, he said, I don't want to build the next Wise. I want to build the capability that powers the next 100 Wises. So effectively, while we are obviously wrapping this up in the cross-border payments conversation, the cross-border payments piece is more their addressable market. It's the TAM. What they are building is the infrastructure and the technology rails to be able to facilitate that. And from that perspective, if we look at the TAM, I was just reading this up. It seems Indian SaaS the market for SaaS grown in India has grown at somewhere around 35% CAGR, which is twice of the rest of the world. So you have like these thousands and thousands of startups and technology companies being grown in India who are effectively exporting to the global market. But let's say you build like a really cool and really sophisticated like AI agent company based out of Bangalore or Chennai or wherever. The moment you get paid for it, you've effectively earned 5% less compared to what you would because of the fees, because of the time, because of the settlement issues and so on. And I think especially where India is at the moment and where the sentiment is from a investment and services exporting in India, this is a brilliant market to start tapping into. Which kind of brings me to why maybe Stripe and PayPal did it, because if it goes wrong, it's a very small bet for them. If it goes right, they've effectively put their foot into hundreds of billions dollars worth of market right in the early stage, right? So they're getting the data, they're getting the flows, they know exactly where to double down and where to cull. I think it's a brilliant move by these two investors.
Yeah, it's amazing as well to see the sort of narrative around India changing dramatically as well. I used to work at Infosys, and actually, the sort of narrative very much was about the world came to India to get resources, and now actually the world's coming to India to invest in amazing startups that have scaled at scale that they could only dream of, to then export those ideas, not just the people, to be in a place where actually they're starting to lead the world in this space, which is amazing. I always kind of find it interesting when look, it's like that whole New York quote: if you can make it there, you can make it anywhere. The needs of India are so diverse when it comes to different parts of it and different, almost completely different types of customers because of the scale of the country. So yeah, if somebody can make something great and it's scaled to such a great place, then it will work everywhere around the world in that regard. So Joe, I mean, this one's an interesting one. Like I say, when we start seeing the Stripes and the PayPals of the world doing pretty meaty investments in different places, that's a really interesting sign of really what the stage that people like Stripe and PayPal are at, but also maybe the insights of where they're looking for growth potential all around the world as well.
Definitely. I think it's a huge endorsement of the company and the region as well. It's quite interesting to see Stripe and PayPal doing almost joint statements at the moment. I mean, it might be a little commentary on where those two are headed. I think that they put out a really interesting statement about the Xflow was saying, we don't want to be the next Wise. We want to be behind the next 50 Wises. I don't know if we need another 50 Wises, but it was a really interesting kind of commentary on what we see in Pulse, the front end stuff. There's huge UX challenges when it comes to international transfers and FX. But really, the biggest challenge remains kind of what happens behind the scenes with the compliance and the foreign exchange and all the kind of back-end technical infrastructure going on there. And that's really what they do very well. So it's actually getting through the hard stuff first. Of course, there are big challenges to remain for those people that do end up using them. But they're really, really tackling the kind of core problem and the one that people might not talk about so much, but really that's where a lot of the pain is felt.
Do you know what? I feel like if the wise guys heard it, they'd be like, yeah, if people start using our business as like the barometer of like a level of a success, I don't think they'd take offense by that. Wise have done a really good job. But,
absolutely.
Albert, what do you think on this one? I mean, you guys have got to be having your eyes on India if you really want to scale at some point, right? That maybe the next round of investment potentially, but there's some pretty amazing things happening in that part of the world.
Well, first of all, it's great to see two of our investors involved in this deal as well, General Catalyst and Lightspeed. It's actually interesting. So in my prior experience at Plaid, and Uber was very much sort of like involved into the B2B cross-border payments as well. And I think one interesting element of that, it's obviously, I think Joey alluded a little bit to that as well, very much sort of like it's a workflow problem as well, not just like money movement. So, and it seems like the company is solving for that, but also a very interesting move from PayPal and Stripe, because like just building out those workflows yourself could actually sort of like be like very niche investment, while the rails and sort of like infrastructure that you're using, potentially it could be coming from those big players as well. So it's interesting bet on really sort of like going deep into the segment, and definitely sort of like huge problem to solve and a massive business that could be built out of that.
I also think this is a bet. This is like a 5 to 10 year or perhaps even more bet on the part of PayPal and Stripe. And for two reasons. One is, like you were saying, David, there is definitely this sort of interest and energy about India. Like Blackstone, for example, have said that India is their top ROI market and they're investing massively. It's kind of no longer an emerging economy. It's kind of well developed and on the path to grow more. But from that perspective, I don't know if you guys recall, but a few years ago when they first set up this CNH-CNY corridor in China, that became a huge differentiator for the banks that were offering. So HSBC, I think StanChart to some extent, like they leveraged that to such a large extent to increase their corporate client flow. India and all of these BRIC markets will gradually start moving along that way. And especially as the shift happens in the services from being a paid per hour kind of put people in seats world into an actually create and build stuff which the rest of the world uses, that transition is going to lead to so much more openness and convertibility. It's almost like a closed system that is slowly starting to open. And I think that's kind of where these two are going in, whether separately or jointly, to say that when the standardization of the rupee happens, when the opening of the rupee happens, we want to be right in on the ground floor to be able to take advantage. So I will definitely be following this with quite a lot of expectation.
Yeah, it's an amazing thing to see. Feels very condescending to be like, well done, India, you've done really well. But because essentially it's changed the market dramatically. Like like you say, gigantic corporate banking really woken up and paying attention. Pretty much everybody in the wealth space is talking about India right now in terms of, where the, people who've done very well are looking for alternatives from a banking infrastructure perspective as well. And to have such a high aspiration, but yeah, that does sound really condescending. I didn't mean it like that. Sorry, India. I didn't mean it like that. All right, we're going to have to move on and get on to all of the other good stuff that has been happening in the news shortly. But we're going to take a quick break. Hey folks, if you're anything like us, you're on the road constantly. Airports, hotels, conference centres, half the time the Wi-Fi feels as safe as shouting, "My PIN is 1234" across the departures lounge. That's where NordVPN comes in. One click or no clicks with Auto Connect. And suddenly, every sketchy airport network becomes a whole lot safer. You still get blazing fast speeds and 8,700 servers in 129 countries, so you can switch your virtual location while you're waiting for yet another delayed flight. One account covers 10 devices, and you get Threat Protection Pro to block malicious links and ads, plus Dark Web Monitor if your details show up where they shouldn't. We've teamed up with them to offer Fintech Insider fans an exclusive deal. Head to nordvpn.com/fintechinsider to get a huge discount and 4 extra months on top, completely risk-free with their 30-day money-back guarantee. Links in the description.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
All right. Now, what we're going to do is a quick break from the headlines to tell you about our next After Dark event. It's only 2 weeks away. Can't believe it. We're recording Fintech Insider News live at the London Village Underground on the 17th of March. And we've just announced the panel. Joining me will be Ross Gallagher from 11FS, Helen Beerton from Lloyds Bank, Clem Sallon from Formance, and Julie Sutton from Paymentology. We failed to mention in this, it's also St. Patrick's Day, so it's going to be really good fun. So it is free to attend, but tickets are going really, really quickly. So if you want one, head over to 11fs.com/afterdark to grab yours. Again, that is on the 17th of March. It's going to be a lot of fun. All right. Next story that we had was one from Fintech Futures. This is buy now, sell off later. Where did Klarna's IPO go wrong? Klarna's much hyped Wall Street IPO initially surged up 15% on its debut and 20x oversubscribed. But 6 months later, the stock is down over 67%, and its valuation has fallen from 15 billion to just over 5 billion. Yeah, just 5 billion. Losses widened as Klarna's push into banking and set aside significant credit loss provisions. And now with wider fintech IPOs pipelined under a bit of scrutiny, where does that really sort of leave us? What are you there? I mean, this is a hard one because people always want to enter into a market with a great valuation, and there's always a bit of a market correction in terms of where people want. So some of this I don't think is crazy and abnormal and everybody should sort of lose their minds. But I guess I wonder if, to the point in this, some other people who are, thinking about launching into the market might just be a little bit more cautious. Aditi, what do you think on this one? Is that a fair summation? Are people going to be a little bit more scared of the waters than usual?
I'm not so sure. I think there's a number of different factors at play here, isn't it? One is the geographical choice. So especially these days, we hear so much about choosing between listing in London and listing in the US and European ecosystem versus US ecosystem and all of that. And I do think there is a definite element of a price difference happening, or almost a leeway difference that has happened because they did not kind of list out in home market to some extent. I do think in Europe, we tend to be a lot more emotional about our babies, like you said. If it's been set up, it's a baby of the country, as opposed to in the US, it's just an investment. If it doesn't price well, I'm selling it off. So I think there's a little bit of a angle there. And I think the other angle also is more just the timing. We have all been, I think, spoiled a little bit by the zero interest rate era and how much liquidity there was in the system. And I'm kind of known for my childcare analogies for everything, David, so you're going to have to bear with me. But when you're taking your kids to the park on a holiday, you're going to let them try their own shoelaces, right? They'll take a long time. They'll make a mistake. You'll teach them. They'll do it again. You'll help them. And then you'll still be peaceful, maybe just slightly impatient while you finally take them out. At 8 a.m. on a morning on a weekday, you're not going to give them the space to do that. You are going to tie those laces. And if they don't, they're going to get shouted at. I think Klarna has very much gone through that phase because the timing is not good liquidity. The opportunity cost of an investor is much higher, and expectations have shifted from believing in a narrative and a story to seeing those results. And the combination of all of these things, it's almost a perfect storm for Klarna. So I almost think people should treat them as the older sibling. It's like, okay, this person learned to drive, crashed the car into the fence. Now, how can I be a bit more careful and take it from there?
Some tough love in your household, I have to say. But yeah, I definitely agree with you. I mean, it is an interesting one that you say there as well. As pre-IPO, it's all momentum and metrics and story. It's the narrative around all of the things, and post that, it's price, right? So it's a very different game that you're playing. Joe, what do you think on this one? Is this a sort of a maybe the remit of Klarna sort of shifting in the landscape of financial services as well?
Yeah, I think maybe that they were trying to be too many things too quickly. They were obviously offering a great buy now, pay later product, but then suddenly, they were a bank and they were leaders in AI, but maybe they weren't, and they're kind of shifting around a lot. And I think that thing around identity and narrative, and then they're IPOing in the US, I think maybe just trying to be too many things for so many people. I just don't think that quite hit the mark, at least not at this stage. So I think it's a bit of storytelling there, and I think Revolut and Monzo possibly have clearer narratives. I know they're doing a lot, but I think they possibly do in their story. So I think they'll learn from that, I think.
Yeah. I mean, it's an interesting point as well. When Klarna floated at 15 billion, they actually thought it was, most people said it was conservative, so actually for this reasonably significant change. Like you say, it's like sort of launching a boat into, nice waters. Those things can change really quickly, can't they? So, Albert, any thoughts on this one?
I think it's interesting from the angle of managing that narrative, and it's probably like the muscle for the companies as well. And I remember when Uber went public, the stock went down as well, and there was like feeling like, hey, just business is not doing great. And many of us, including myself, actually sold part of the our stock, but then sort of like it was a rocket ship after that. I think what is important is I don't know so what's going on in terms of the sort of like core fundamentals of the business, but then the market is like very noisy. Klarna is amazing business, and I think that the team is great there. So I'm pretty sure that they're executing on sort of like long-term strategy there. And that's kind of like just putting this a little bit in comparison to more private companies like Stripe, Revolut, reporting the great valuation increases almost like every week. But the thing is, they are valued not by the market, by the private investors that are looking a little bit long-term, looking a little bit deeper into the business, while the public markets are a little bit noisy and just like reacting on some narrative. So I'm curious what would be impact of this with sort of like some of these companies maybe actually staying for longer as a private companies, just like seeing benefits of being a private business.
Yeah, I mean, it's worked out pretty well for Stripe, right? But it is interesting. You know, shareholders should never be driving your product roadmap, right? But I imagine it's going to be leading to much more complex conversations at the board with regards to, what are the things we're doing to layer that valuation back up to make sure shareholder value is being created across that as well. But
I don't think that's necessarily that bad a thing, though, David, in the specific Klarna case, because if you think about it this way, if they have decided what their roadmap is, if they have decided that they want to expand from being a buy now, pay later company only into offering more banking services and going properly into the credit space, then they do need to have the capabilities of managing, reporting, monitoring that credit a lot better. They don't seem to. They do then need to shift from the Klarna model of how many losses you can take and how much lending you write off to the bank model of safeguarding your balance sheets and having the right reserves. And therefore, that shareholder scrutiny, perhaps not dictating the roadmap, but nudging them to frame that roadmap with the right guardrails, need not be a bad thing for the company and by the shareholders by consequence.
Yeah, I think so. You are right. I think that balance there is important. I think the challenge often, depending on what type of shareholder it is the forgoing of the midterm or the long term for the short term.
Absolutely.
And getting that balance right is often, a real challenge, particularly in sort of incumbent organizations, because often what they're facing into is technology debt that doesn't get solved in the short term. Whereas Klarna, a modern day business built on great technology, their ability to innovate and develop product is very different. So it's kind of a prioritization of the speed of returns rather than putting off the heart surgery that you need. But yeah, super interesting. I hope these guys continue to thrive in the market and acquire customers. But I think you are right, Aditi. I think it's about being in a situation where they mature the offering to continue that relevancy to the market. Last final story that we had for the week that we're going to move on to. This was one we picked up on Finextra. And I'll be honest with you, when I read it, I got this one totally wrong. Chase to open 160 branches in 2026. Don't panic. I don't think that's Chase in the UK before anybody freaks out. That's what I read it as. And I was like, holy crap, did not see that one coming. JPMorgan Chase is opening more than 160 new branches this year while renovating another 600. This is following the commitment made in 2024 to open 500 new sites, renovate 1,700 and hire 3,500 staff over 3 years. The expansion includes low to moderate income and rural communities, as well as fast-growing regions across the US. There it is, guys. All of this at a time when many banks have been shrinking their physical footprint. There were some really good stats, actually, from the Financial Brand. Shout out to Jim Maroose and the guys over at the Financial Brand. In the decade after the 2008 financial crisis, the US saw the net declines of more than 1,000 branches a year. During the COVID peak from 2021 to 2022, nearly 6,000 branches closed. But in 2023, net decline of 1,500, 2024, net decline of 1,100, and 2025, net decline of just 400. I mean, it's pretty interesting, really. I mean, we've all been sort of talking. And I know the US is different, and it's not like there's an ATM on every corner if you live in Texas, like you just don't walk through an ATM, right? So the role of the branches are much more important in, communities all across the US. So, but we have been sort of provocating of the demise of everything physical. Joe, what do you reckon on this one? It's a weird world where we're sort of getting excited about, bricks and mortar, but
I know.
But actually it's a service that's critical to many, isn't it?
Yeah, I was actually a bit disappointed it wasn't the UK as well. I think that would be more of a headline, and the way it was kind of written kind of suggested it could have been. But no, it's I think it is still an interesting story, and I think it is perhaps just an endorsement of the importance of human interaction still, especially when it comes to larger stake items, larger deposits, larger loans, these kind of things, and how digital works for large populations and growing populations, but there still is a huge importance for brick and mortar, for in person. So I think it's also kind of playing to the strengths of the traditional banks about building that trust layer that perhaps fintechs have struggled to attain en masse. So I think it's interesting because it looks like a step backwards, but it's more perhaps a commentary on the market as a whole.
Yeah, I guess it's an interesting one for international sort of audience to be like JPMorgan to open all of these branches. It's not really JPMorgan, this is Chase. Like actually, when you think of Chase over in the US, it's an everyday bank for everyday people, and I think they've got something ridiculous like 60 million customers or something. It's absolutely huge. So, but it was quite an interesting point that they were making to push explicitly into low income and rural areas. I thought, Aditi, that felt like them trying to establish themselves more and more as the kind of center point for communities across the US. Like that for me feels like a good use of space when you're going to do those things, because you're engaging with communities that might need more support.
100%. And I do think, like, very rarely in business and especially in banking, does there rise an opportunity for doing the right thing and the good thing and for doing the commercially intelligent thing. But I think this is something that Chase is very much doing. So if you look at this quote in the article from their CEO, Jennifer Roberts, she says, "Each branch represents our promise to stand alongside our customers as partners, helping them navigate and achieve their financial goals." So the way Chase is positioning themselves is they're definitely trying to buy that trust almost. They want to be there when it counts with the people who are absolutely going to be neglected by their competitors who are now increasingly digital. They're challenger banks, they're AI native. They might perhaps compete on a vector of customer experience, but for people who are savvy enough to be on a digital banking app. Chase wants to go all the way back and go to those areas and those geographies where perhaps this is an underbanked client base and use their wherewithal from a pure capability and resources and money perspective to be able to plant themselves there when it counts. And therefore, I think this is actually a very intelligent move, because once you have gone in there, once you have this community branch, once you have these like education centers and these local people staffing those local branches, you buy that trust. And the reason I keep saying buy that trust is because they published numbers which said that their spending this year, not just on the branches, but overall, is going to be $105 billion, which is like much higher than that last year by more than $9 billion. And the market clearly didn't like that from a share price perspective. But however, if you look at what that translates into from an ROI perspective, they have already demonstrated that these branches have brought them in a significant increase, not just in terms of the deposits that they're getting, but also in the ability to cross-sell then into things like mortgages, into things like insurance, into things like other affiliated products, which are much higher from a fee perspective, which are much stickier, and which therefore buy you much more penetration and higher wallet share from your customers. So I think from an economic perspective, as well as an ethical/community perspective, it is a very smart move by Chase.
Yeah, it is interesting and sort of in a dynamic of a global landscape of fintech banks versus big incumbent banks. It's not really a move that I would see a fintech do, and actually trying to figure out the unique advantage of being an incumbent in that space is pretty smart on their part. But Albert, it's an interesting context, isn't it? With all of the advancements that we've got from technology and AI and, adoption and, everybody carrying, a mobile device with them, then sometimes actually the sort of human interface to that, then there are communities out there that are not as technologically savvy or, pretty much every community is not financially services savvy either, so having these outposts is, in some instances, probably a good idea.
Absolutely. I think it's interesting that, so first of all, like US market is very different. It's sometimes hard to even imagine sort of like the needs of the customers there because they have a different context. And I'm pretty sure this move makes sense in that context. What is interesting, even in the our community is like digital first, and I'm like a digital first person. I don't remember last time I visited the branch of the bank. But at the same time, what I've experienced recently working with one of the leading neobanks here in Europe as well. So when I had a critical problem that I needed to resolve digitally, so the customer support just became like really bad. And so especially sort of like in the age of AI, sort of like everyone is trying to automate the customer support. And literally sort of like I couldn't resolve the issue for a month. And if I had a branch where I just show up and try to resolve the problem, that would be very helpful, even sort of like in our digital first context. So I think in the sort of like areas that are like super sensitive as like money movement, I do believe that some hybrid approach makes sense.
Yeah, I think your point, Aditi, on trust, I think is exactly what Albert says there. I mean, trust is built in those moments of like absolute need, aren't they? And Albert, to your point, it's like, yeah, it was going really well until I like actually needed something slightly off normal, and then I had this experience with I'll say it's DHL. Dear God, if somebody has a phone number to actually get in touch with DHL, it's almost impossible. Like being put through and hanging it up and, automated thing and hearing this machine type and predict. It's just crazy, and yeah, the DHL guy was trying to deliver to my address but had the complete wrong address, and there was no way of telling them that, everything else is fine on the core happy journey, but when you stray off it becomes really, really difficult. But yeah, well, I think again, I do feel on this one the big banks being able to do things that challenger banks or smaller banks or community banks can't afford to do is actually probably an interesting strategic move on the banking battlefield. So we'll come back and talk about this more, I'm sure.
The other angle with my Snowflake hat on is that this is a power move from a data perspective. Have all of you seen The Big Short?
Yeah, my story about The Big Short was my wife is like a big Office fan, so when she saw Steve Carell was in it, she thought it was going to be a comedy. So surprised me and took me. She was not expecting that to be a banking crash story for 3 hours, but I really enjoyed it. Go on, sorry.
That is actually a great story and like quite emblematic of misplaced expectations as we have in like so much of the markets. But, when those two traders, this story reminds me of this, when those two traders go out into the hinterland and they're literally knocking on doors that people have walked out of when they can't afford to pay back the mortgages, Chase is on the ground now. Like you are collecting so much data by just having a presence there and onboarding these new customers and getting on these new deposits and getting the mortgages from a section of the economy which you perhaps normally might not have accessed, but which effectively determines so much more of what happens to the economy in the future. When you overlay that with AI capabilities and scenario analysis capabilities and predictive modeling, I think they are going to be sitting on a treasure trove of data which very few of their competitors are going to have. Every single customer interaction, every single sign of vulnerability, it is really, really clever to see what they could do with that. So I think that's another kind of aspect of this which is not very obvious through the news story, but over the next few years is definitely going to build up to be a big advantage for them.
Yeah, it's an interesting point. If it's a developing demographic or a young demographic. I had a primary bank account relationship for 15 years because they came into my school and gave me a clipboard. These things do happen. All right. On that note, we are going to have to wrap up this part of the show. We'll be back with you really shortly. Okie dokie. So now is a time for a quick look of the stories that we didn't have time to cover in full. And I can't believe we didn't cover this one in full. I'm sorry, Richard. Allica Bank hits unicorn status. Big deal for you guys. Lots of other stuff happening, I know. UK SME lender Allica Bank has raised 155 million in a Series D round, valuing the business at 1.2 billion. The round includes most common equity plus additional tier 1 capital. So this is a pretty serious bank grade funding round. In just 5 years, Allica has built a balance sheet of nearly 4 billion in SME loans and over 5 billion in deposits. It now serves 30,000 SMEs in the UK and says it wants to double that penetration to 10% by 2028. Look, massive congratulations to the team. To be honest, I know I've said this on the show before, but the minute that Richard went and took that role, knew that he was going to absolutely crush it over there. So yeah, super proud to say that I called this one. But and actually, if you want to go back and listen to the show that we did with Richard, I have no idea what number it is, but just Google it, you'll find it. It was really good. All right, so I guess. And finally, is always a really fun one. And we talked about them a little bit earlier on the show, but this is a very different context. But JPMorgan opened a bar for employees if only they could actually get in. I don't know if you guys saw this one. It's funny. Wall Street Journal. So how do you fit 10,000 bankers into a 55-seat English pub on the 13th floor of a 3 billion skyscraper? Sounds like a weird setup to a joke that you didn't need to hear. But welcome to Morgan's, Jamie Dimon's in-house gastro pub in the sky. Located inside JPMorgan's new 3 billion HQ at 270 Park Avenue, it has an English pub aesthetic, serves fish and chips, shepherd's pie, Guinness, like everything you would expect, but just for 55 people. I feel like this is like a man cave gone crazy, hasn't it, basically? So Dimon reportedly banned printing his face into Guinness foam after concerns it looked like a vanity. It looks like a vanity project. Yeah, it sort of looks like a vanity project. And the pub has a strict no day drinking policy. So I guess some things have changed in banking, I guess, over the years, haven't you? But first off, Jamie, if you're listening to this, I'd love an invite. Like, that would be fun. So I'll happily come and have a drink with you. My Jamie Dimon story is getting told off sitting in the... I don't know if anybody's been to JPMorgan's offices in New York, but there's a little cornered off bit, and that's where apparently Jamie Dimon comes down to reception and hangs out sometimes. I just wanted to sit down, so I kind of went through the rope and sat down. Got told off quite largely by some really big American guys. So what do you reckon to this one then? Is this a fun, hey, look, you've got loads of money and you can make a fun thing for your employees to go and do, even if it's only 55 at them at a time? Or is this just a bit of a silly sort of, Joe, should we get one of these in the 11FS office? Maybe starting there.
Yeah, I think that's a great shout. I think that will get people in for sure.
But that's the thing, it does sound like something I would do, but maybe not Jamie Dimon. You know what I mean? Like, so maybe he's way cooler than I thought he was. Maybe that's the story.
Yeah, is it the start of a bit of a rebranding from him and JPMorgan? I don't know. But I can definitely see there being long queues because there's a lot of customers to get in there.
Yeah, well, 55 seats and 10,000 employees. That's going to be a weird. It's going to be a weird rotation. He's going to have to do like back-to-back outings for like a couple of years to rank through all of those people, isn't he? But Aditi, have you had an invite to this sort of strange location, or is it just us who's been left off the guest list?
I'm still waiting, David. And I think that might be because of my Jamie Dimon story, which was actually in JPMorgan's New York offices. I had visited there when I was working with JP in London. I passed him in the corridor and I was like, oh, that person looks familiar. I didn't even stop and say hello. And this is the classic moment. You do your elevator pitch, you have your 30 seconds with the man, and I completely blew it. So I don't know if and when I will ever go in there again. But I must say, I think this almost seems a bit like, if you want to see the celebrities, then book a table at this restaurant rather than somewhere for the employees to actually hang out and change the culture a little bit, because the numbers just don't stack up. It's like in most fintech companies here, you're walking around having Nerf gun fights and getting free beer at 4:00 on most Thursdays. It's like, why bother with so much faff around something which could be done a lot more easily?
I mean, it does get into I think a sensible argument about if somebody was going to be a pub manifestation, who would it be? JPMorgan, I think Goldman Sachs, because isn't that guy a DJ as well?
Yeah.
I mean, the alcohol would be great, and he would just rock the party as the DJ of the setup as well, But maybe that's where he's going. Maybe he's a good karaoke singer.
Exit
I
strategy.
don't know. Yeah. Albert, I mean, after the big fundraise lately, is Crazy Man Cave on the agenda, or do you think the investors might get upset about that?
I was just thinking that we'll need a lot more rounds and a lot more progress on all our goals to to get to that point. But who knows? Just maybe just visiting first their bar in New York. After you described it, I got very curious.
Yeah, yeah, it's probably a good idea. But when you get to that point, all right, when you've crazy, again, going from all the companies you've got, and you've got all of that success, and you create that pub for 55 people, then us three are coming. Just so you know.
Deal.
Perfect. All right, Joe. I really like on this story as well is it wasn't making the pub, and it wasn't doing all the things. It wasn't the, stacking the bar or the, the size of it. That none of those things were too far. But Jamie didn't want his face printed on the top of the Guinness that way. Do you know what I mean? They read through all the things, and it was at that point he was like, "No, this is too much." But it's good to know that there is too much. There is a level. But all right. On that note, we are going to have to wrap up the show. It's been a lot of fun. Thank you so much to today's guests. Where can people learn a little bit more about you and all the good stuff you're doing? Joe, starting with you.
You can find me on LinkedIn, but you can find out more about Pulse at 11fs.com/Pulse. And there's 20,000 user journeys from banks and fintechs from all over the world, and heaps more features coming. So check it out.
Sounds good. Aditi, where can people come and talk to you more?
Exactly the same. Please find me on LinkedIn, and you can learn more about Snowflake on snowflake.com. Please do make sure to check out our Cortex AI offering and Coco, the agent.
Very cool. Albert, where can people find out more about you and all the good stuff you're up to?
Yeah, very similar. Check out my LinkedIn page. I'm sharing a lot of updates, also stories about building the company. So you can go to stacks.ai for everything for finance agents that we're building.
Very good. As for me, I'm no longer lurking on LinkedIn. LinkedIn sucks, but drop me an email on david@11fs.com. More than happy to hear from you there. That does wrap up today's show. Thank you so much for listening to this episode. If you did like the show, or if you do like what you've heard, then please make sure to follow us on pretty much everywhere you can find us on social media. If you want to continue listening, or there's any other episodes you've missed, just look for us on every podcast platform at this stage. As always, if you want to join the conversation, you can find us on social media. Just search for 11FS or Fintech Insider. Or if you don't want to email me, email podcast@11fs.com instead. Thanks again for listening, everybody. Goodbye.
Want to see your brand on TV? Roku Ads Manager makes it easy to launch targeted ad campaigns in minutes, track results in real time, and drive on-screen purchases with just a click of the Roku remote. Get a $500 match on your first $500 spent with code ROKU500 at ads.roku.com. That's code ROKU500 at ads.roku.com. Terms apply.